you, Professor George. So the way I'm going to put my presentation is more like, what's the point of taking Professor George class, and how far can it take you? So let's say you take Professor George class, like one of the options. So one of the biggest one that you have is how to identify good portfolio managers. Like you may see a Warren Buffett, or you may see Prem Watson or John Templeton. So if you take Professor George class, you will have a chance to identify them. So if you cannot do value investing yourself or be an investor yourself, you can always give the money to them. The second one is, let's say you join the profession, either as an analyst or as a portfolio manager. So let's say you become a portfolio manager. And if I practice value investing, I start by Professor George, and he's following what Benjamin Graham has taught. Where will it take me? Let's say I do it religiously, passionately, I follow all the principles, and execute it as good as I can, even if I make a few mistakes. Where will it take me, let's say 30 or 35 years down the road? So I have 5 mutual funds, and luckily, because I have 5 mutual funds, I can now show you the results. Like if I'm among the best ones, that is pretty good. But you'll be surprised, how well my funds have done. So the next slide I'm going to show you is how my funds have done. So in this one you can see, right? Like my Chou, so I have 5 funds. We are competing with our peers, and they are all in different categories. So the Chou Associates fund basically is I'm competing with people who are investing in US equities. And you can see after 30 years I'm ranked number 1, and straight through I'll be ranked number 1 over 35 years. Right. So Chou RSP fund, the next one is I'm just buying Canadian equities. And where do I rank in Canadian equities? You can see after 20 years I'm ranked number 1 straight through. Right. And then let's say I go to Asia Pacific. I'm investing in China, Japan, and India, and all the other places. How am I doing against my peers? And you can see against my peers again, like I've been ranked number 1 just from 3 years onwards. And the only one that I'm not ranked number 1 is a Europe fund. The other one is a fixed income fund. Chou bond fund is in fixed income. We are buying bonds, and you can see even in bonds, if you apply the proper principles, I'm ranked really high. Now who are the guys ranking second and third and so on? So I went through the list, and most of them are value managers. Most of the other funds that are ranked second or third are value managers. And so you can see the power of, the principles really work. So where else can I apply it, right? So the next one is this one here. So in 2017, in May of 2017, I was offered to buy Stone Trust, an insurance company in Louisiana. And I do the same thing. And what are the ingredients there that will allow me to be successful? So then I looked at the balance sheet, and the ones that are highlighted are really important. So if you notice, when you have an insurance company, and this company was in workers' comp, you have investable assets, the cash and investments. I call them like investable assets, 128 million, right? And then you look at shareholders' equity. In 2016 was 52 million. So it's more than 2-to-1 ratio. That's the important thing, 2-to-1 ratio. So if I do 5%, right, 5% return on the investable assets, it would translate to more than 10% on your shareholders' equity, right, on your equity. So that was the key, right? If I do 10% on investments, then it will translate to more than 20% on equity. So since I consider myself, let's say, a decent fund manager, decent investor, why can I not work that magic on a Stone Trust? So let's go ahead and look at the fixed income instruments for Stone Trust. When you have an insurance company, you have to invest a lot in fixed income, right? So COVID hit in 2019 and 2020, it affected the bond market really badly, especially the oil and gas. So if you look at this, so what you should look at is the cost base, like the third column from the right, and the bond price. Bond price is what was the price of those bonds at the end of the first quarter of 2021. You can see almost every one of them has done really well. So, most people, when they go into the bond market, you know how they play. The treasuries are giving you like 0.5%, and they're trying to make a return of 0.6%. If you get 0.6, as if they're doing really well. But look at how I was doing it. I didn't care about all that stuff, playing the yield curve and all that. I just went for undervalued bonds. And as the bonds got hit, I was buying them. And why was I buying them? Because they are really cheap. So these bonds, for example, like Antero Resources, I bought them at 43. But I knew in good time I would get 100 cents on the dollar. So in a few years down the road, I will trade close to 100. And same thing, same logic was that. But what happened if it went bankrupt, if those companies went bankrupt? So the key thing is if they went bankrupt, the question is like for Antero Resources, would I get 43 cents? 43.25, and my answer was yes, because it was supported by reserves, enough oil reserves there on the ground. So each and every one of them, you go through that same analysis. You're doing something really safe and getting great return, because if it goes bankrupt, you would get your principal back. Not principal of 100 cents, but the principal of what I paid for it, right? So you see, huge returns. Look at Athabasca. I bought it at 22 cents on the dollar, and the coupon is 9.875. So what is 9.875 divided by 22? You're getting almost like 45% rate of return just on the coupon alone. On top of it, that 22 cents went to 100 cents on a dollar. A year later, I was able to sell it back to the company. They were buying back the bonds at 100 cents on a dollar. So where can you make returns like 22 going to 100? And we're making it in the bonds. Because we apply the same value principles as we apply to equities. So what about equities? So we can go to the next.
Francis, so when you bought them at the cost base, did they keep going down or?
Yeah, some of them kept going down. I kept buying them.
You buy more?
Yeah, I would keep buying it, but those are average costs. Whatever. Yeah. As they go down, I would just buy them, because if it is cheap at 43 cents. Let's say they were just taking the first one, if it goes down to 35 cents, it's even cheaper and even a better buy. So you never let market fluctuation, disturb, disturb, what you want to do, like make you weak and all that. The cheaper it goes, the more bullish I am on how well the
value is there.
Yes, value is there, and that's your goal. So you have to have that way of thinking. Yeah.
So the coupon is not important to you? Or the maturity date, or are you assessing the maturity date based on how long you think the event will last?
Yes, so maturity is really important. So if you notice, most of our maturity doesn't go, doesn't go really long, except for General Electric. But that is a different type of a bond I was playing.
Right.
Right. So if most of them, I kept it as short as possible, within less than 10 years. Yeah. And if you notice, predominantly they are around 4 or 5 years, because you want an event to happen.
Yeah.
Like when it matures, an event happens, they have to buy back at 100 cents on a dollar.
And do you want to be sure your event will resolve within a certain amount of time?
Yeah.
Yeah.
So you just want to make sure the assets they have under the ground is worth whatever you're paying for it. And then you also have to look at the seniority of the book, where does it stand in the capital structure. You want to go as high as possible in the capital structure for the returns that you're going to get. Because if it goes bankrupt, the way the assets are distributed is based on seniority in that capital structure. So we take all that into consideration. So the next one is what Professor Josh has been teaching you, the equities, So you can see how well we have done in equities. This one is the fourth quarter of 2023. So the key thing is to look at cost base and market value. And I'm not just picking the winners and putting it up there. It's the whole portfolio of Stone Trust. It's the same thing that I did it with the fixed income portfolio. And you can see we have big winners. Not like just at a 5% gain or 10% gain. A lot of them we have double and triple, whatever we paid for it. And we bought them all at prices that we thought was way cheaper than whatever the company is worth. Right? So you can see value investing really works. And because of that, because we've done so well in bonds and equities, and even in equities, if you notice, we have some great companies, some crappy companies, crap, and some, what does crap means? CRAP. Means you cannot realize a profit. So those type of companies we have, right? And it doesn't matter if you buy them cheap enough, it will work out well. Cheap enough in terms of not the price going down, but cheap in terms of in relationship to what the company's worth. And you have to be really accurate to what a company's worth. If you're really wrong on assessing what the company's worth, you will get into big time trouble.
What were you thinking about Stellantis? Like, how did you think? Because Stellantis is like the merger of three companies, right?
Yeah, component. So you do some of the parts, and then they're selling off the assets, and whatever they can get out of it, you're getting paid back in dividends and all that stuff. So when you do the whole work, it's worth more than double at that time when I was buying it.
Because the key figure, I guess, was Sergio Marcione.
Yeah, yes.
Who died though, and then.
Yeah. So you bring up a really important question. In all these companies that you buy, the person running it is really important. So you have to get into his head. After a while, you'll see how this guy is thinking, how he's allocating capital, where is he putting it. If there are weaknesses in the company, does he sell it or is he wasting money? And do you trust his judgment in buying companies? And will he dispose it at a good price? So that guy was really outstanding. Unfortunately, he died, but all his successors are doing all the right stuff. And when you get excess cash, right, and you don't know what to do with the company or with that cash, you're supposed to give it to the shareholders. And they have been given back to the shareholders, either through buybacks or through dividends. So Stellantis met all that criteria. So let's go to the next one here. So you can see, so this is the question of, strong trust. Like in 2018 that I was buying it, you can see the book value was $64 million, right? And because we did so well in operation, they did well in operation, plus we did really well on investments. And normally insurance companies are not supposed to do as well as this. They're sleepy companies, boring companies, no growth, and all that stuff. But you can see 64 million, and you can see at the end of 2023, it's worth 159 million. We show it as 149 million, but they paid $10 million in dividends. So when you add that back, it's $159 million. And has been a great investment.
Can you explain a little bit about how the insurance company helps you with the float, and if you're an investor?
So the insurance company has, how it generates float is that, like you all have to buy car insurance. Let's say you pay $2,000, right? And that $2,000 stays with the insurance company unless and until you have an accident. Then they have to pay out as claims. So because it's staying with them, that $2,000 is staying with them, that is the float. And that is, I can invest until there's an accident. In the meantime, I can make money on that $2,000. So that float is really important. Without that float, it's no point going into an insurance company. It's a company, on average, where the return on equity is only 5%, and the growth is only 5%. But if you know how to invest that float, that's where you get this type of return.
And the comments like Berkshire,
so Berkshire Hathaway, Warren Buffett was the first one to do this, right? And then Fairfax did it, and now I'm doing it. Once you understand what Buffett was doing it, because he was outstanding in investments, and he said, in this insurance company, I can do it. I can apply that principle, and I could get the returns, like 2-to-1 ratio. So you're getting a leverage 2-to-1 without the danger of borrowing money from a bank. So that's the key. As long as the insurance company doesn't lose money, you're paying nothing for the float or for that money to invest. So you're getting that leverage. So I'm getting more than 2-to-1 leverage, without all the consequences of borrowing money from the bank.
So it's like a free loan, basically.
Free loan.
But you have to be a good investor, otherwise.
You have to be a good investor. If you're a lousy investor, that 2-to-1 ratio will kill you. So you can see, so when I was doing this, right? So insurance company have something called reserve, and reserve means, let's say, if you have an accident, you report it to the insurance company. You have to set up a liability and say, okay, this could be, let's say, $1 million liability, because of the severe accident, a few people died, right? So those are reserves. So you have to estimate, how much the damage would be, So if you notice, when we're doing stone trust, a lot of companies would cheat. So reserves are set. Reserves are set like more as an estimation. There's nothing fixed, right? let's say it's $1 million, but you don't know, it could be $500,000 to $1.5 million or $2 million, depending how the judgment goes. So we got all these results by being really conservative. So what this means is that likely range, let's say 50%, probable 50% would be, let's say reserves are between 70 to $130 million. So if you set it up at 100, you're at the 50% level. We set it up at 90% level, really conservative. So so if you look at the probability distribution for our reserves, should be around, let's say, $56 million, right? We are setting it at 71.3 million. So what it means with the book value is that if the book value is 100 at 50%, right? Our book value, because we are saying at 71, would be closer to, you're putting it closer, our book value would be at 86 million. What most insurance companies do is that they cheat on this, and this is why you need something, you need to know insurance companies, and this is part of valuation, is do you understand how they are setting the reserves? See, a lot of companies, they will cheat and they'll set the reserves, let's say, at 38 million. So if they set it at 38 million, suddenly you're showing your book value instead of being 100 million, they show it as if it is at 135 million. That is their cheating you. So if you go into valuation of these companies, you have to understand all these, how the reserves are set, and then you have to question it. You cannot just do it based on book value, because anything that has to do with estimation, even in banks, you have to be conscious about it. You cannot just take their word for it. So if you're doing valuation, you have to break it down and say whether it is that insurance company, whether it's under-reserved, over-reserved, or just a reserve like at the 50% level. So that is key. So valuation is you cannot take their word for it. So some of these slides I'm showing to you, I'm just showing you the results, but a lot of stuff that is part of this is also part of valuation. The next one is also part of valuation. So what happened was, these are the numbers from the end of 2021, right? So what was happening was that a lot of, most insurance companies, including banks, were buying long treasuries. Long treasuries, they're buying 25-year, like AAA.
Zero interest rate.
Zero, like getting 10 basis points. And they're going like 25 years. Maturity is 25 years and 30 years. And what do you think I was doing? I went straight cash because I didn't want to risk. Now, so much money has been printed, and there's always a chance that inflation will come back. So this is also part of valuation. So if you're looking at the banks or insurance companies, you have to say how are they investing that cash, their investable assets. So when I was looking at it, I would have rejected most of the banks and most of the insurance companies because there was danger lurking and they did not know. They said they were really safe. They were, rated AAA securities and they're buying the right stuff and really safe. And I was only going on cash. And I said, that AAA security, this AAA disaster waiting to happen. Right? So you can see, so we went with this, and you can see how safe we are playing here, right? So we had in Louisiana, we have a #1 peer, they're A-rated. At that time, we were B-rated, right? So you can see, this is just to show you how safe we are at Stone Trust. Cash divided by carried reserves, #1 rated is like 19.8%, right? And the second one is 25.2, right? But at Stone Trust, we were at 115.9, just the cash portion. So you can go through each one of them, like cash divided by net premiums earned, same thing. Like we had 184.6. We were just sitting happy to stay in cash without earning any interest at that time. So we looked stupid for a while because whatever they're making were only like 5 basis points, 10 basis points, or 15 basis points. But they were not seeing the danger that was lurking. The same thing with the banks. When you look at the banks at that time, none of the banks were doing the same thing. They had so much cash there, with the deposits, and they were going into long treasuries. Right? So you can see what happened next year, in 2022. These are the, AAA papers that they were in. And when interest rate rose, those US Treasury went down by 40%. So that is also part of valuation. So you have to, when you go into anything like banks and all that, insurance companies, don't just go on book value and all that stuff and pay, okay, if I buy it at 10% discount of book value, I'm getting a great investment. You have to go to each item in the balance sheet, each item on the asset column, and each item on the liability column, and try to understand how they are deploying that money, and whether they're taking risks that they're not aware of, and whether they're doing stuff just because everyone else is doing it. Like, I'm willing to be different, right? And that's the key.
So the blue line is the value of the bond, right?
Yeah, how it went down, yeah.
And
So
that's,
it went down from 147 down to 87.
Once the rates were going up, they were
Yeah,
going down.
going down. Whereas I did not take any hit. And when time came for me to exploit the market, I would just go and do that. So that is also part of investments. When things are hot, you stay away from it, and eventually, when they crash, then you go into it. So this one is, we have our capital is growing so rapidly. What you do with it. So in December, we had a chance to buy into Loggerhead. They use all these fancy terms just to impress the students. Like Reciprocal is just Reciprocal means an insurance company, right? But this was a different setup, right? So what happened was Hurricane Ian hit Florida, and it hurt a lot of insurance companies. So the capital got disrupted or destroyed. Like Citizen, which is a state insurer, they had $6 billion in capital. When Hurricane Ian hit, the capital went down to $3.8 billion. So in insurance, normally you cannot write a certain amount of business. So if a capital is 100, you're not supposed to write more than 3 to 1. Most likely 2 to 1 is the safe way to go. But if your capital goes down to 50, you cannot write it at 300 if your capital is at 100. So you have to get out of the market or give the policies away, right? So you have to be really cautious. If the capital goes down, you cannot write. Write means you cannot have the premiums coming in. You have to reduce your premiums. And premiums is equivalent to revenues. So a lot of other insurance companies were doing the same thing, right? They had to get out of the market because the capital got destroyed.
Can you talk about the conversion ratio a little bit to understand? Conversion ratio of 6%. Can you explain a little bit what the conversion ratio is?
Oh, the ratio? Yeah. So the next question is the conversion ratio 60%. So that's the next topic. So in this one, because the capital is getting destroyed, we have Progressive, one of the biggest company in America, and also a big presence in Florida. They wanted to get out of the market because they got hammered in Florida. So they came to Loggerhead, and we didn't have Loggerhead. We just started that on December 1st, 2022. So Stone Trust supplied the capital to get into the business. So Loggerhead, so they went to Loggerhead and they said, I have more 150,000 policies. We cannot renew those policies. Can you renew it in Loggerhead's book? And we got all that business for free. Remember in December 2022, we had no business, we were just starting, right? So they came to Loggerhead, right? So we said, okay, we'll take it. We will take as many policies as we can. So normally when you, let's say if your insurance company is ABC, and ABC doesn't want to renew with you, ABC will send you a letter, saying that for your renewal, go to this company, like Loggerhead. So they send all that notice to the insurance, all those who bought insurance. They said Loggerhead will be the one providing your renewals. So what happens is 100,000 policies you get it, right? We don't have to take all 100,000 policies from Progressive because they could be in dangerous zone. And we can pick and choose the zip code where we want. We know how hurricane would head in a certain direction. And so normally the conversion ratio is, we found, because we did this trick in December of 2022 with Bankers Insurance, the conversion ratio is if there's 100,000 policies and you want to renew it in a Loggerhead's book, like what's the percentage that you could renew it at a higher rate? So our ratio is 60%. That's what we mean by the conversion ratio. So when it goes to a Loggerhead, we raise the prices by 40% and see whether it will stick. So let's say with Progressive and a few other companies, like their policies were at, let's say, $1,500 per policy. When they went into Loggerhead's book, it was closer to, let's say, $2,800. So you won't make money at $1,500, but at $2,800, you're going to make a lot of money. So we went from starting starting with 0 premiums in December of 2022, and just 14 months later or 16 months later, you can see by 2025, our premiums, our gross written premiums will be close to $300 million. Just from nothing, yeah. So in this one, the main thing is not the Reciprocal, not the insurance company. The way it is set up is more set up like a management company. They will get fees for managing the insurance company, and that's where we own 90% of it.
Are you able to charge these higher fees because there's no other
No
insurance?
other carrier, yeah.
Yeah, no one else wants to write insurance at that time?
Yeah, at that time. So that's the reason why when you go into insurance, it's almost like value investing. When everyone wants to go into it, you get out. And when everyone is getting out, you go in, and then you get the prices that you want. So in this one, why we went in is 2 things. One, we felt the prices will be much higher because everyone is getting out, and no one is making money at $1,500 per policy. Second one is you needed DeSantis to change the legislative changes. So there were big abuses in Florida, and that's the reason why they were not making money. So one of the biggest abuses was assignment of benefits, AOB, assignment of benefits. So you have let's say a rainstorm, and then you have one guy come in the next day knocking on your door, saying, I can get you a big new roof, as long as you assign me the benefits. You're insured with this company, and whatever insurance company pays, you assign it to me, but I'll give you your new roof. So he goes to your roof, looks at it, and there's maybe one shingle disrupted or something. He said, no, you need total whole roof because the roof got destroyed. Right? So when it goes to a lawyer, the claims goes to $25,000 to $35,000. If you do it yourself, right? If you just change one shingle, it's only $5 or $10. But if you change the whole roof, it's only like $5,000 to $10,000. Let's say for your roof, put in new shingles. But if it goes to a lawyer, it goes to $25,000 to $35,000. And that's where the abuse was coming, and that's the reason why they were losing money. So in December of 2022, all that changed. DeSantis came in and changed the rule. So the assignment of benefits was taken out. So you can see all the tailwinds we got. But we went in at the right time when everyone was scared, getting out of Florida, we were going in. Right? So you can see now how much money we can make here, right? So you can see, so this is LRM. So this is a management company that manages the insurance company, and we get fees of 20%. And basically you make a 40% margin on those fees, and so you can see year 2025. If you look at 2025, our pre-tax income will be $20 million. So we own 90% of it, like for $9 million. So the whole deal was for $10 million. We put in $9 million for 90%. And at $20 million, these companies go for 15 times pre-tax income. So even if you put a price of like 8 times, what is 8 times 20? Like that's $160 million. And normally I could sell it for 120 at 15 times earnings. That would be closer to $300 million. And the whole deal was for $10 million, and we only put in $9 million. Right? So next thing you have to look at when you're looking at valuation, right? And is all those earnings are not the same, right? So this is, you want high quality earnings. And what does high quality earnings mean? It means it can be taken out. You can throw it out as cash, or you can use it for acquisition, anything else. So in this one here, they can pay it as dividends. Like on that $20 million, let's say 2025, they can pay out $15 to $16 million out. They don't need it for the business. A lot of other companies have lousy quality earnings. They need to put back into the business in terms of they need more inventories, they need more receivables, they need more fixed income. And that would be crappy type of earnings. You cannot take it out. So you want companies that can grow rapidly without putting up too much capital to make it grow. And this is where you're getting it from this loggerhead. So the way it's set up is how are we getting the capital in loggerhead, right? So when you put, let's say your insurance policy is, let's say $3,000, right? $3,000. 10% of that, 300 goes into this capital. That's called members' contribution, and that will be supporting the capital of of this reciprocal. So that's the way it was set up like this. So let's say 2025, right? If the gross premium was like $300 million, if I go back, like 2025, like 298 million, right? 10% of that is, let's say 30 million, 29.8. That will go back as capital for the reciprocal. For the year 2024, we have like 200 million in premium, gross premium. 10% of that is 20 million. That will be going in as capital for the reciprocal. So we have this capital base that is set up to generate more and more premiums. So we don't need to put in more money than whatever we have put in. So that's the beauty of a reciprocal. But it has some dangers to it, and you have to be aware of it. So normally, when you take a class like Professor Chou, all this valuation is there. You have to ask, what are the dangers here? Just like you looked at banks and insurance companies, like for the other one's cash, where it's been deployed. Here you have to say, are they cheating on reinsurance, which is quite likely because they're making money on the management company on the fees, and so because we are there, we make sure the reinsurance coverage is properly done. So most companies would cheat on reinsurance, right? So whereas I did not do that, like because we own it, I have a big say on how the reinsurance should be set. So I set it up, that an event happening. So we do the modeling, and then happening. You want an event happen once in 158 years. You want that severity, right? And I'm willing to pay up for it, not to have a big loss. We call it the tail of the business. So on the tail of the business, you don't want to take a big loss. A lot of other people would cheat and take only an insurance of 1 in 30 years, an event happening once in 30 years. So we tell them, instead of once in 30 years, it's happening every 5 years now. Right? So you need to be really safe when you're playing all this thing. And therefore, the guy at the top in insurance company is really important. He will set the tone, not to cheat. So if you go with Berkshire Hathaway, that aspect of the work, if you're doing value investing, you can kind of don't have to investigate because Buffett will do the right stuff. So if you go with, let's say, Fairfax, with Prem Watson, I know Prem Watson quite well, he will do the right things and take proper reinsurance coverage. Now, there's a price to be paid for reinsurance coverage, and that's the reason people cheat on it. So to get the 158 years, let's say if your gross premium is 100 million, you have to pay 1/3 out, and that's an expense. So 33 million goes out as ceded premiums to reinsurers. And I'm happy to pay for it because I don't want my loggerhead to be destroyed if you have a severe, let's say another Hurricane Ian comes in. So all those are part of valuation. So don't take, the word, whatever the company says, just take it at face value. You have to check each and every item on these. So that is what I want to show you and show you, what we have done. If you take value investing, how you can utilize, that knowledge, that investment skills, to your career, and how well it has done, if you stick to it.
So how do you figure this thing out? I mean, a lot of little detail, legal stuff, accounting stuff. How do you figure this thing out? I mean,
if you want to do the right stuff, right way of doing it, you just have to go and do it properly and look at all the small little details. So the first 5 years are all this stuff. After that, one of the great things about value investing is knowledge builds. First 5 years of stuff, you need to know, let's say, 50 companies or 100 companies. After that, you're just adding more and more information on it. Like every quarter, they come up with their quarterly earnings. But you have to do it properly and do it, proper valuation. If you don't do it, and you cheat on it, cheat the system, and then something like this will come and hit you. And then your numbers, your performance numbers will get hammered. What you want is that, when bad things will go against you, it's not a great thing. Even like I did not do really well for the last 5 or 6 years, and I really hurt the results. But overall, it will do really well. But you want to be left standing, not like crushed when you make mistakes. And I got all these results by making a lot of mistakes. But luckily, they were not something that would crush you, or something that will set you back a little bit. But then you move forward.
Sure. Oh, sorry. When you were talking about like buying bonds, and you said to people buy them cheap, And look at the resources that are in the ground, make sure that they have enough resources to cover
Yeah, so you look at proved reserves.
So where do you get that information for the?
It's all in the,
in their filings?
nowadays it's really there. They'll give you how much natural gas that they have, how much oil they have, and they will also give you the life of the reserves, and that's really critical. You don't want the life of the reserves just to be 2 years. You know why? Because next year, about 2 years later, they have to explore. Revenues are gone if it is only 2 years.
Yeah.
And it's not worth anything. So you like to have the reserve as long as possible, like 10 years to 15, 20 years. Because you have to think about how oil and gas works, oil and gas companies work. They drill for oil, and in that basin. And if it is exhausted, your revenues are gone. So what's the value of that company? Is only value based on whatever they can get in those 2 year period. After that is zero. So you want them to have long lasting reserves, right? And when you're hunting for reserves, hunting for oil, that sometimes you're playing on luck. You have a lot of dry holes. You have to take that into consideration. So all these oil and gas companies, we made sure the reserves were 2-to-1 ratio to the price that I was paying for it.
You don't do independent assessment of the reserves, right? You trust what you see, I guess, there?
Yeah, so, but that's the reason you make a question. You cannot do an independent assessment because the companies won't allow you, to get all that data, right? But that's the reason you always have a question. So same thing, if it is worth 100, I'm buying at 60. So it's not a discount just looking at like 40% discount to 100. That discount is more like a discount in case I make a mistake. It's maybe not worth really 100, it could be worth only 75. But if it is worth 75 and I'm buying at 60, I still have that safety I have with that cushion against human mistakes, and it's really easy to make. I've made so many mistakes, but when you make a mistake, you have to just own up. When you make a mistake, own up as quickly as possible. If you don't own up, it drags on, and then you cannot get back on track. Yeah, yes.
During that COVID period with really low interest rates, when you said that you stayed cash.
I stayed in cash because at some what are you going to? How much money are you going to make on 4 basis points? So you know what 4 basis points means? 100 basis points is 1%. 4 basis points is nothing. So if I buy T-bills and it's giving me, let's say, 15 basis points, when you go to the broker, right? They want to take their cut and they're taking 20 basis points as their fee. So in the end, you come out negative. So I just stayed in cash until an opportunity will come back. And an opportunity will always come at some point if you're patient enough.
No, I know. My question is why did you choose to stay in cash rather than deploying that in a different instrument?
The question is first is, can I find them? Is it in the market? Are there different instruments? Can I find them? And second one is that if I do find some great values, can I quickly get out of it and buy, let's say, into the oil and gas? And so mine was, something will happen and I want to have that cash ready and deploy it really quick. You have to buy these oil and gas within that 1 month period. Otherwise it goes really quick. You won't get those prices. It can spring back really fast.
Just one question with regards to what you mentioned of the 1 in 30-year events occurring now 1 in every 5 years. Of course, in certain essays from the former Bank of Canada, Bank of England governor, I've read that the costs of certain climate-related events are making it more challenging for investors in more traditional industries. Have you found that in insurance, for example, there is less potential for gains because of these events happening with more frequency?
No, so what you do is we call it modeling. So we have an actuary and he will model it. And so if these events were to happen, we just raise the prices, right, to compensate for it. And that's also the same reason sometimes when you go into the insurance companies, there's another thing you need to check, how soon are these reserved? All these claims and blah, blah, blah. How soon does it? We call it the tail of the business. In workers' comp, we know that we can settle those claims within 3 years. If you go into really long tail, something that will sell in 30 years or so, or 20 years, you'll be in big time trouble because you don't know your cost. If you're wrong, you're only knowing it after 20 years. So for example, in homeowners, the tail is only 3 months. So in 3 months, we'll know whether we're pricing it correctly or not. In workers' comp, we'll know it in 3 years. So that it's important to know the tail of the business, and you need to work on modeling. We model all these things every year. We are modeling it for all these likely events to happen. Yeah, so good insurance companies will be always conscious with it. And if we cannot model it, then we'll cede the insurance, cede some of the risk to the reinsurer. So the quote was, the way it worked is when I first went into it, the amount of money we have to pay, the first retention was $2 million. And I felt that was too dangerous. I quickly went there and I said, I just bought the company, I want that to be reduced to $600,000. So any claim that comes in, we'll only take $600,000. Anything above that will be paid by the reinsurer.
So what do you do? Like, you go to work in the morning, what do you do for the day?
No, I just read the newspaper and that's it. I read the newspaper.
No, there you read newspaper, what the?
Yeah, but like if you look at the stocks I have today, I'll have it 5 years down the road, so it's buy and hold. And you know why I do buy and hold? Because you earn huge rates of return compared to when you sell it in 1 or 2 years. So all of you have calculators and you can do it in your head, all right? And you can do it roughly. So as you know, the capital gains tax rate has gone up to what, 33 or 34%, right? But for easier calculation, just take it as 40%, right? Right? So let's say you make 20% a year and you sell it after 1 year. So after 1 year, after 1 year, you'll pay your tax of 40%. So if it be 8%, your rate of return is only 12%. And let's say you do it over 4-year period, 4-year period. So 12% over 4 years is what? So you have 40 divided by 5. Like, at 12 means your money is doubling every, at 12% is 6 years, right? 4 years, 7 times double. And what is 2 to the power of 7, like a nerd would do it? What is 2 to the power of 7? Right, 128, right? So it goes to $128 million. That 1 million goes to like 128. But what about you make your 20% and you keep that stock forever? Keep it for 40 years. So what is that 20% rate of return after like 40 years, right? So we'll be closer to, let's say, most likely 1.4 million or so, right? And if you, what is 60% of that? Now you take your tax rate. 60% of 1.4 is, so you can see that is like 600 million or so, or 800 million, sorry. And that's a difference between 128 and 800 million. Because when you hold on to that stock, buy and hold, you keep that money, that 8% you're going to pay to the government, you're keeping that, and that is growing with you. So a huge difference. So you can do it on your calculator, and that is really important. And Buffett found that formula. I understood it when I was reading about it. So it adds a lot of difference to the return. So 128 versus, after tax, getting 800 million on the other side.
Last question, Ross.
Yeah.
Do you have any books you recommend reading? Do you have any books that you recommend reading?
Basically, investment is really tricky, right? The math part of it is really easy. The 5%, the math part, the calculation. Is how you react to the market. It's really important. Like if the price goes up, you get influenced by it and you want to buy all these beam stock and whatnot, right? And price goes down, you get really depressed. It means, no, I don't care about all that. And therefore, if you want to read psychology books, so the key thing is reading all these psychology books, not to apply to other people, but to apply to yourself. Like how you react to all these events happening. And that's the key to it, Some are made for it because they ignore all these stock prices. Like I don't care about where the stock price is going up and down. I'm only concerned with the intrinsic value going up, whether measured by book value or earning power. But all the other stuff, I don't care, like where the price goes up and down. You can even see, like on this slide I didn't put up. Let's see. So this one, I was writing this report in 1999, and all the tech stocks were going up, And I said, no, you can see what I read. This is straight from my annual report of 1999. And I said, paying 500 times for hardware is not an investment, it's pure speculation. But everyone was caught up in it. Everyone went into high tech, right? And then, then I went on and on a little bit. And then I said in the last paragraph something, it's a fool's game. And then basically you're thinking of buying at 100 times revenues and you're hoping to sell to someone, another big idiot at 200 times revenues and making money like that. And that's the wrong way to go. But so many people, so many smart people got caught up in it. And whenever have that inclination, I wrote it, have a cold shower. And until that feeling passes. So that's the key to investment. It's not all this math stuff that we are doing is 5%. This is the battle you will be facing all the time versus market forces telling you, if you don't participate, you're an idiot. Yeah.
So it sounds like a lot of what you do, like in your investing strategy, has to do with patience in
Yes.
capital and
Yeah.
patience in liquidating positions. So how do you
Patience, capital, and also you're a rational person, a person with reason, and that's all you're going to contend with.
Yeah.
It's you against the world. It's not you against all those idiots buying all these stupid prices.
How do you have specific processes in place where you try to manage that patience or try to ensure that you have that patience throughout your organizations or throughout your
So it's, we call it culture, we can call it discipline, and but the inside of you, deep inside of you, you will just play this game and not any other game. Because if you destroy this game, your capacity to think rationally, you will destroy whatever potential you have as an investor. You get caught up in that euphoria, and then it's really hard to get back.
What do you think has affected you in life, I guess, to make you, I guess, to contrarian, I guess? Because what are things, if you go back to your life, what things affected you that made you so?
It is just I was attracted to logic, right, and a reasonable person with reason, and you can reason it out. And then I was affected, like Buffett, when he first thought he would be highly successful, said, people are so irrational. I can beat them. But then you have to be rational yourself, and you have to define that. So when I read about Benjamin Graham, I said, this is so rational, like chapter 8 and chapter 20 are the key ones. That says you have to buy them when it's undervalued, and everything else is speculation. And if you do that, you will be be successful. So you can look at it another way, like when I was joining the business in the 70s, like long time ago, no one was born in this class except for Professor George. Like 1981, I started my fund, right? So I knew value investing will really work, right? And when you want to go to the top of the profession, it's something like 1 out of 10,000. 10,000 investors, to be at the very top, it's 1 out of 10,000. So huge competition, right? And it's really hard for me, who's only grade 12 education, to go and make it. But then I found out, like in Canada, there were only 10 value investors. And those are the ones that I'll be competing with. So even I'm the worst guy, I'm number 11th, I'm still among the best investors. So that was the key. And Buffett found it the same way. They're so irrational, I can make money easily, but he has to define it for himself to be rational. So you have to take out all the speculative behavior, all those bubbles that come in the way, and you will do very well.
Okay, what advice would you give the students here?
Value investing, I know it works for me. I showed the proof. It works for Buffett, works for Fairfax, works for John Templeton. As long as you stick to it and make sure you're disciplined, you're passionate, and you don't betray those principles, it will work out fine. You need perseverance. Stay with it 10 years, 15 years, and eventually numbers will prove themselves, and people will come and invest with you. Like I never marketed my fund, and it has done quite well.
Okay, the students have to do projects now. Okay, ask the
I just
question.
had one more question. It was in terms of the principles of value investing themselves. Have you ever invested in a company or some kind, and basically invested in anything where you deviated from those principles? And if you did, why and what were the deviations?
Yeah, I sometimes would deviate and then I get crushed. So sometimes I made a bet. I remember a long time ago on Denison Mines, and I made a bet based on the outcome of a legal lawsuit, thinking if they win, I would take double or triple the money. And they didn't win, I lost, but I didn't go by numbers. So you don't want to base it on a legal outcome or something like that. Or something, a government outcome of certain policies and things like that coming to pass. So what you want to do is, you have to have in a position, let's say on inflation versus deflation. Like I have always been cautious about inflation because I went through the period in 1970s. I lived through it. Hardly any portfolio manager have lived through it. I've seen interest rate going to like 19% or 21%. So if I make a mistake, I'm always on the inflation side. If I make a mistake on that side, I won't get hurt. If I go on deflation and thinking interest rate will go to 0% or 0.1%, if I'm wrong on it, I'll get destroyed. So always stay on the side that if I'm wrong, I will not get hurt.
Okay, thank you very much.